this oil story, the fare hikes, has actually been going on for some time, and we can even say that the war was started, or the invasion of Ukraine by Russia was started on February 24th. That had already rocked markets. Why yesterday was this such a massive sell-off? And what are the new support levels here?
With respect to the market is fearing inflationary pressures. That's the number one problem of the market right now. Yesterday there was this rising fears with respect to Russia's oil exports being the target of the next economic sanctions. In fact, we already saw that last night, though it's limited to the U.S. for now. The U.S. has decided to ban imports of oil coming from Russia. But by the end of the day, the Russian oil supply could be taken out of the global market either voluntarily or either by force. And of course, once that happens, oil prices are expected to rally further. And of course, this is expected to cause inflationary pressures for us. So aside from that, we're not just, of course, oil is the number one problem. But aside from that, you also have other products. You have corn, you have wheat. Wheat is Russia and Ukraine are both exporting heavily wheat, while Ukraine is heavily exporting corn. And if you're going to look at the PSA's data, Philippines is an importer of corn and wheat. So if the supply of corn and wheat are going to be disrupted, in the global market is going to be disrupted because of the ongoing war between the two, then of course it's going to it's going to push its price upward, which of course will add inflationary pressures to the Philippines. If you're going to look at the BSP's projection, their project their if oil prices hit $120 per barrel, they expect inflation for the year to average 4.4 to 4.7%. If you're going to look at inflation right now, we're for this year we're averaging 3% so far. So from 3% to 4.4 to 4.7%, it means that moving forward, if this is going to come to pass, then inflation is going to take higher jumps moving forward. So inflation is the main problem of the market right now. Adding to that is, of course, the worries that because of these rising commodity prices offshore, import costs going to rise. And with the rise of imports comes higher trade deficits, which is of course going to weaken our external position. We're already seeing the anticipation of that right now in the currency markets. You're going to look at the peso; it's already depreciated below $52 per barrel, below the $52 pesos per dollar mark. And of course, the decline in the local currency is also negatively affecting the local pulse. So these are the factors at play right now, which is causing the bearish sentiment in the market.
Japhet, I'm sure you're watching the oil story very, very closely. It's now 130 a barrel. I mean, how much higher can this actually go? You already mentioned that it's likely that oil from Russia will be taken out of global supply. Is there even a level here that you can already price in?
Well, to be honest, we don't have any specific level. We're not yet looking at any specific level. But moving forward, if this tension between Ukraine and Russia continues, then of course if other countries will follow suit with the U.S. move to ban Russian oil imports, then of course oil prices are expected to surge even higher. Well, if you're going to look at Russia's projection, which is quite grim. Russia's projection is if we're going to take out their oil exports out of the global market, oil prices could reach $300 per barrel.
Wow.
So that's really horrible.
Wow.
And we're hoping it doesn't reach that. But that is something that we cannot discount. If this oil disruption really happens, or if this oil disruption really pushes through, and it's really problematic for the global market, for the local economy, and of course for the for very own local equity market.